One of the features of the Great Recession and the Great Depression is the failure of so many banks. One of the questions is, why do banks fail? Banks fail for two reasons. First, they overextend their loans to individuals with poor credit risks. Two, depositors fear that the bank is in financial trouble and withdraw their money from the bank. In reality, both reasons may happen more or less simultaneously. Let's suppose that our bank has the following budget or balance sheet. The bank has assets of $1,100,000 in loans and required reserves. The bank also has liabilities of $1,100,000. According to accounting principles, a solvent bank or a bank that is in good financial health, the bank's liabilities should equal the bank's assets. Thus, our bank is financially healthy because $1,100,000 in liabilities is equal to $1,100,000 in assets. Now suppose that Bank A loans $990,000 to individuals to buy homes. Some of the individuals are poor credit risks, but were able to get loans because of aggressive loan officers and the borrowers not fully understanding the terms of the loans, or they were good credit risks but lost their jobs due to recession. As a result, borrowers may not be able to pay their loans. Since the bank cannot collect on its loans, it takes a loss of $900,000. According to accounting principles, when liabilities exceed assets, the firm becomes insolvent or goes bankrupt. Our bank fails and our depositors lose their money. Another scenario is that depositors fear that a bank is in financial trouble and decide to take their money out. Once again, our bank is in good financial health. Our bank has $110,000 in required reserves against a $1,100,000 in liabilities. One morning, depositors show up and demand all of their money. Well, the bank will pay out the $110,000, but it will be unable to pay out the remainder of the money. Only when the bank can satisfy its depositors, it will have to ask borrowers for immediate payment of their loans. While some borrowers may be able to pay the full amount, not all of them will be able to do so. As a result, borrowers will default and the bank will be unable to collect the money. Once again, the bank's liabilities will exceed its assets and the bank will go bankrupt. Most banks fail for two reasons. First, banks make bad loans, followed by depositors fearing that the bank is failing and demanding their money. The bank attempts to collect on their loans to remain solvent and causes more people to withdraw their money from the bank, which in turn causes the bank to demand more people to pay off their loans. Second, depositors think that the bank is failing and demand their money, causing the bank to be unable to meet its reserve requirements. The question naturally arises, how can depositors be protected? One way is to let the banking industry develop ways to handle the situation, like having a special fund to cover bank insolvencies or having a super bank that would lend money to banks with cash flow problems. However, neither of these two solutions work in the long run because banks are becoming larger and larger and the amount of loans that they have are becoming larger and larger. So the government can intervene. The government can intervene in two ways to protect depositors. First, through something called deposit insurance, where the bank buys insurance from the government and the government insures the depositor. Second, having a banker's bank or a central bank run by the government to provide money to banks as they need it. First, let's look at deposit insurance. Generally, deposit insurance can be sponsored either by a nation, a state, or province. In the United States, deposit insurance is sponsored by the federal government through two independent agencies, the Federal Deposit Insurance Corporation, or the FDIC, and the National Credit Union Administration, or the NCUA. Both agencies insure deposits up to $250,000. The FDIC and the NCUA protect consumers in two ways. First, They help financially troubled institutions find a buyer who can take over the customer's deposits. 2, if the buyer cannot be found, then the FDIC or the NCUA will reimburse the depositor directly. In the state of Massachusetts, the state government also insures deposits over $250,000. A bank in a difficult financial position can borrow from other banks or from a central bank. A central bank is a bank set up by the government to provide banking services to banks within a country. A central bank is often described as a lender of last resort. In the United States, the central bank is called the Federal Reserve System. The Central Bank of the United States, the Federal Reserve System, is an independent branch of the federal government. The Federal Reserve System is made up of a 7-member board of directors, including a chairman, who is currently Ben Bernanke, 12 regional Federal Reserve banks, and the Federal Open Market Committee. The Federal Reserve Board is made up of a chairperson who is appointed by the President and confirmed by the Senate. And there are 6 members of the board. The current members of the board are Janet Yellen, Elizabeth A. Drake, Daniel Tarlow, Sarah Raskin, and there are currently 2 vacant seats on the board. There are 12 Federal Reserve districts, each with its own bank. Each district bank is headed by a 9-member board of directors, including a chairperson. Members are drawn from industry and banking. The country is divided up into 12 districts, and each district has its own bank. Some districts will have a branch office in addition to the main office. District 1, or District A, has its main office in Boston and is referred to as the Boston Federal Reserve Bank. This district includes the state of Maine, Massachusetts, Vermont, New Hampshire, and Connecticut. District 2, or District B, has its main office in New York City and is referred to as the New York Federal Reserve Bank. This district only includes the state of New York. District 3, or District C, has its main office in Philadelphia and is referred to as the Philadelphia Federal Reserve Bank. This district covers about 3/4 of Pennsylvania. District 4, or District D, has its main office in Cleveland and is referred to as the Cleveland Federal Reserve Bank. This district covers about 1/4 of Pennsylvania, all of Ohio, and part of Kentucky. District 5, or District E, has its main office in Richmond, Virginia. This is referred to as a Richmond Federal Reserve Bank. This district includes Virginia, West Virginia, North Carolina, South Carolina, and a small part of Kentucky. District 6, or District F, has its main office in Atlanta and is referred to as the Atlanta Federal Reserve Bank. This district covers Florida, Georgia, Alabama, part of Mississippi, part of Louisiana, and part of Tennessee. District 7, or District G, has its main office in Chicago, Illinois, and is referred to as the Chicago Federal Reserve Bank. This district covers the Lower Peninsula of Michigan, the northern part of Indiana and Illinois, Iowa, and the southern part of Wisconsin. Notice the blue triangle in the lower right hand, or the southeastern part of Lower Michigan. This is where the branch office of the Federal Reserve Bank is in Detroit, Michigan. District 8, or District H, has its main office in St. Louis, Missouri, and is referred to as the St. Louis Federal Reserve. This district covers the southern part of Illinois and Indiana, the eastern 3/4 of Missouri, about 1/2 of Kentucky, and the northern section of Minnesota and Louisiana. District 9, or District I, has its main office in Minneapolis, Minnesota, and is referred to as the Minneapolis Federal Reserve Bank. This district covers the southern part of the Upper Peninsula of includes the Upper Peninsula of Michigan, the northern part of Wisconsin, Minnesota, North and South Dakota, and Montana. District 10, or District J, has its main office in Kansas City, Kansas, and is referred to as the Kansas City Federal Reserve Bank. This district covers western Missouri, Kansas, Colorado, Wyoming, Oklahoma, and the northern section of New Mexico. District 11, or District K, has its main office in Dallas, Texas, and is referred to as the Dallas Federal Reserve Bank. This district covers Texas, southern New Mexico, the middle section of Louisiana, and Texas. District 12, or District L, has its main office. The Federal Reserve provides banking services and supervision, including check clearing between states, providing funds and loans to banks, and overseeing banking practices. The Federal Reserve also controls the money supply to the economy by controlling the reserve ratio, the buying and selling of bonds, the discount rate, that is the interest rate a bank must pay to borrow from the Federal Reserve, and the federal funds rate, the interest rate that the bank must pay to borrow from another member bank. The tools of the Federal Reserve are controlling the reserve requirement through the reserve ratio. The Federal Open Market Committee buys and sells bonds to influence the money supply. The federal funds rate, which is the interest charged by a bank when it lends to another bank. The discount rate, which is what the Federal Reserve charges banks to borrow from it. The Federal Open Market Committee influences the amount of money in circulation by buying and selling bonds. The board is made up of 6 members from the Federal Reserve Board and 5 members from the 12 district banks on a rotating basis. The New York chairperson is a permanent member, and 4 are drawn from the remaining 12 district banks. The discount rate is the interest rate charged by the Federal Reserve System to lend funds to a bank. There are 3 different types of rates. There's the primary credit rate, which is the interest charged by the Federal Reserve to institutions in good financial shape. The secondary credit rate, which is the interest rate charged by the Federal Reserve to institutions in poor financial shape. And then there's a seasonal credit rate, which is the interest charged by the Federal Reserve to institutions depending on the time of year. That is, lower rates during the winter and holidays, higher rates at other times. The federal funds rate is the interest rate charged by a bank to lend funds to another bank. The rate is currently between 0 and 0.25%. The goal of the Federal Reserve is economic growth with stable prices. The Federal Reserve seeks to achieve this goal through an intermediate target such as the money supply or inflation targeting.